And we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Welcoming you back here for another bi-weekly session with the macro maven herself, Stephanie Pomboy. Hi, Steph. How are you?
I'm great. How are you?
Well, I got to tell you, I'm feeling an awful lot better than I was even 24 hours ago. Recent viewers of the channel know that I caught the flu traveling internationally last week, and today's the first day that I feel like I've rejoined the world of the living.
Well, welcome back to the world of the living. I don't know. These days, describing it as the world of the living might be a little generous, but it's pretty wild out there. But here we are.
Well, look, and I understand too that you got to recharge your batteries a little bit over the past week, and you're looking refreshed.
Oh, well, thank you. I showered especially for this
Oh,
occasion.
hey,
Oh my God.
all right. Well, look, everybody, hope you're all having good summers as well as we kick this off in the heat of August here. Let's see, there's a lot to talk about, Steph. I want to, if we can, at some point, I want to talk to you about tariffs. I've kicked over a little bit of a hornet's nest on X Twitter about this, and I'd love to add your thinking to mine here. But before we do that, we got the latest inflation data this week, and relatively muted, right? And we can look at a few elements to say, oh, they're a little bit higher than folks expected. But I mean, we're still talking about a CPI that's still got a 2 handle on it and came in as expected. So that seems to give the Fed more air cover to cut here. We also are seeing some increased weakness in the jobs market. Continuing claims continue to march up. And so the market's expectations for future Fed rate cuts this year, it's been ping-ponging around all year, but now it's game on again, right? I think the market's expecting 3 or 4 cuts in 2025 alone. And then, of course, perhaps more in 2026. So let's start there. Do you share the market's opinion that we are about to enter an era of Fed cutting here?
Well, I think we're definitely going to get a cut or two by the end of the year. What happens thereafter remains to be seen, because as you said, directionally, the headline inflation numbers continue to move in the right direction. But the core is a little sticky. And I guess, there's this question, in my view, of the shift toward stockpiling of resources that I think will continue to keep upward pressure, or at least hold high commodity prices in general, and oil in particular, notwithstanding all the efforts to, deregulate and drill baby drill and all of that. We're just living in a world where the demands on resources are so enormous, at the same time that you have this geopolitical sort of Cold War going on to stockpile those precious resources. So I think that is an element to the inflation picture that is not going to be moving in the Fed's direction. The question always comes down to who pays that. That increases cost of production to businesses. The question is, how much of that are they able to pass on to consumers? And as we've seen with the tariffs so far, contrary to the hysterical hair on fire headlines when Trump was talking about tariffs, and everyone glibly described it as a tax on the consumer, what we found is it hasn't been a tax on the consumer. It's been much heavier tax on the corporations, and particularly on the global exporters, because they've had to absorb some of that on the back end. So again, I keep coming back to this resistance on the part of consumers to absorb higher prices on things that they can afford to live without. So I think that in the aggregate, I'm not looking for CPI to move substantially higher. I think that it's just going to be stubborn. It may not move significantly lower. And I think the PPI is the number to watch, and we'll get that tomorrow. Not that tomorrow's number will be particularly informative, but I mean, over the longer term, I would expect the pressures to be more profound at the PPI level than at the CPI level, to the detriment of corporate profit margins. But of course, that's the song that I've been singing for quite a while. They keep reporting these robust earnings I will say, however, and I've got this little chart printed out here. You can't see it, but the latest Treasury receipts and outlays just came out. The monthly budget report came out yesterday, and year on year, corporate tax receipts are now negative. So at the same time, corporations are reporting, resplendent growth in earnings year on year, or at least the S&P 500 companies are. Corporate America is remitting to Treasury negative. The remits to Treasury are down year on year. So something isn't adding up there, and I don't know if that's related to the shenanigans. If you look at maybe GAAP earnings.
That's what I was going to ask. Yeah.
Yes.
Is it
also,
okay?
It's probably related a little bit to GAAP. We also saw, I think, a record increase in share buybacks, which of course distorts the earnings per share figures by boosting them. And then finally, we're talking about the S&P 500 companies, but there are thousands, tens of thousands of companies out there that are paying taxes to the Treasury. So it could just be a reflection of the same dynamic where, just like in the consumer space, you have the corporate sector haves and the have-nots, and the fixation on the S&P 500 gives you a very different impression about how the average corporation is doing relative to what this tax receipt data shows, which is that things are middling at best, if not deteriorating.
All right, and that's important to underscore, which is, I think most folks watching know this, but there are different ways in which you can account for your financial statements. There's GAAP, there's non-GAAP, there's pro formas and stuff like that. And so there are ways to make your company look more profitable to your shareholders and look less profitable, say, to the government. It can be gimmicked, it can be gamed.
Yep.
Where tax receipts really are kind of where the rubber meets the road. The government either gets the money or it doesn't. And so, Steph, do you generally think that tax receipts are a kind of cleaner signal of the true health of what's going on in corporate America?
Yeah, I mean, the only thing you have to bear in mind when you're looking at tax receipts is if there's any change to the tax code. And right now, the one thing that's changed or changing is the
accelerated depreciation.
Yes, exactly. So,
but is that already in effect? Can companies be declaring that?
I think so, isn't it?
Okay.
I'm not sure. I need to.
I honestly don't know.
Yeah.
I'm thinking like a consumer where you do your taxes at the end of the year, but if businesses are doing it quarterly, then maybe they are actually.
Yeah.
But that would be building a lot of, property, plant, and equipment if we're already seeing a reduction in tax receipts from that this early.
Yeah, absolutely. So, I mean, I just think it's a red flag that bears note, especially at a time when you see the stock market hitting all-time record highs every day on this assumption, which you tweeted about yesterday, and you're dead on, that now any talk about recession is so passe. Like you got to be a moron or a dumb blonde to be thinking that maybe there's a chance that there's still a recession coming. So right now, the markets, it really feels to me so much like a blow off top, where everyone has now decided, like, all the dangers that we were freaked out about in April and at the beginning of the year have been completely quashed. And not only are there no dangers on the horizon, it just looks like blue skies forever. And of course, now the Fed's going to cut rates. And so we're off to the races. Never mind the history that it's precisely when the Fed starts cutting rates that you really want to crawl into your bunker. So it does really feel a lot like that to me. But I will confess, and your audience already knows it, that I've been really concerned about the elevation of equity valuations for a long time. So, you should toss my opinion wherever you think it belongs, probably in the waste bin. But it just really feels very stretched. And when you look at some things like insider buying versus selling, which has turned really negative, and then all of the bid has come from retail, as well as the corporations buying back shares themselves, basically to grease the exits for the insiders who are selling. So all in all, the setup to me, and I'm not a technician, and I know you talk to a lot of people with better insight on the technical patterns, and it just looks a little toppy.
Yeah, and you just banged out a number of signals that, the historical patterns show that this is kind of where the party really gets raging, and then the wheels, then the cops show up, right? And of course, and maybe it's the pattern because of human psychology. It's when the party gets its most intense that everybody wants to join it, right? And that just might be what's required to end these cycles, is just the excess that then can't be supported, right? So I'm not saying this is your prediction, but it wouldn't shock you if we see a continued run up from here in equity prices in the short term, right? As everybody who's been on the sidelines finally capitulates and jumps in, and you have the institutions who have been playing it safe who now have to get in and show that they're in all the hot stocks, and then everything just starts melting up, and then at some point the invisible dog whistle blows and the party ends.
Yeah, or just everyone who can get in has gotten in. And so there's just nothing left to push the market higher. I mean, it's hard to imagine when you already have record share buybacks, how much more they can do. And retails, they're pretty all in. And like you said, I mean, the marginal impetus from here is hedge fund short covering, because they've been, really very defensive. And I think that's what's caused these markets to keep moving higher, is that the retail investors are basically sticking their finger in the eye of the hedge funds. And eventually the hedge fund guys who are charging obscene fees for underperforming are forced, to capitulate and get in. But I just, maybe I like the synergy around it, but I just feel like we probably will continue to march higher, and the market will top on or around September 17th, which is the next Fed meeting when they're going to cut rates. So somewhere around there, I think you'll see the top in the market. But again, I've kind of given up on that whole battle, because for me, the fixation is on how do paper assets perform relative to hard assets. And even now, you've got hard assets outperforming the S&P. Gold miners are trouncing the Mag 7, which are leading. Look at NVIDIA is up, I think, half the amount that the gold miners are up this year. So silently, hard assets are really massively outperforming the market.
It's funny, us long-term hard assets investors almost don't know what to do with this good fortune. It feels so foreign to us after some rough years. All right, look, a lot of places I want to potentially take this. So first, just to underscore for folks here, we're spitballing, but if you hate this rally, if you don't trust it for a number of the reasons that Stephanie is skeptical of valuations right now, doesn't mean it can't get crazier. So just be careful how you position yourself in the near term. If your thesis is on lower prices ahead, they could go higher, maybe even a lot higher before the party ends. Let's see here, Steph. So let's assume for a moment that your expected arc happens, and we have a peak, and then there's some fairly material market correction here. Is it the kind of thing that you think would take everything down with it initially? Or will it be more of a rotation out of the high flying, highly speculative instruments into the more value and more hard asset oriented stuff? In other words, could say this hard asset rally that started, could it get even more octane from here as capital rotates towards safety? Or is this the kind of thing that would just sort of bring everything down together because of margin calls and fear and all that stuff?
Well, it depends on how severe it gets before the monetary and or fiscal response, and I hate to cop out with that, but if the markets turn down and the Fed refuses to come rushing in with the fire hoses, at least initially, then the downturn will feed on itself, and you could see a reduction in leverage across the board, which would ultimately also bring down hard assets, probably on a much smaller relative basis, but still, just to the same way that a rising tide lifted all asset boats, so will, the receding tide beach them all to some degree. So I think that's the risk. But over the longer term, it seems pretty clear that given we keep talking about this, the untenable fiscal backdrop in the inability of the U.S. economy to withstand interest rates, not even higher, but at their current level, we need, we're going to need some aggressive monetary response. And that will inure to the benefit of hard assets.
Okay. All right. Well, look, that's to come, and as it unfolds, we'll chart it here. But it does seem, like I said in the intro, that the probability of the Fed cutting is now becoming much more expected. So what are you expecting here? There's some whisper that maybe the Fed might do 50 basis points. I'm not sure that that's entirely likely. I think that might be like a bit of a freak out factor to the market if they start with that. But what do you think?
No, I totally agree with you. I don't see them going 50. I think 25 seems like a no question right now that they will do the 25, and then maybe do another 25 in December. But for me, what they do with the Fed funds rate is really secondary. I mean, it's interesting to think about it from the standpoint of the amount of pressure that's being put on Jay Powell and the changing composition of the Federal Reserve, et cetera. But to me, my singular focus on September 17th is going to be what happens to the 10-year, because lowering the Fed funds rate accomplishes nothing if it doesn't bring down rates across the yield curve, and specifically private market rates, mortgage rates, corporate borrowing costs, et cetera. And so far, all of the speculation about Fed rate cuts, whether it's 25 or 50 in September, has failed to really reduce borrowing costs to everybody else.
Right.
So I think that's kind of an interesting signal as to what we can expect when the Fed actually does cut rates. Even if we do get a rally in the long end, it's not clear how dramatic that will be or how long it will last, because again, I think we're starting to see real increase in credit stress, especially around the consumer. And you and I have talked about that a lot with the resumption of student loan payments and the knock-on consequences that's having for credit card borrowing and now even mortgage delinquency rates. So I think that you're starting to see a little bit of a tightening, credit tightening to consumers for sure, but even in sort of the low tier corporate sector borrowers, you're starting to see a tightening of credit conditions. So if that happens, even as the Fed's cutting rates, it's not going to provide any relief to private sector borrowers.
Okay. Well, that makes sense. And obviously that's, one of the things you and I have been talking about, right, is we hang out at these even current interest rates for longer, and more debt has to mature and all that stuff, right? I mean, that's just that sort of ticking time bomb we've been talking about, especially on the consumer side. When you add in the repayment of the student loans, as you mentioned, this contagion effect might be starting to cascade through the system, but we'll see.
I have one quick comment on that. Also, in the Fed's budget report, the Treasury's budget report yesterday, they tell you the average interest rate paid on Treasury debt outstanding. Do you want to take just a guesstimate as to what the prevailing average interest rate is that we're paying on our $37 trillion in debt right now? I mean, I hate to put you on the spot, but
I'm trying to figure whether I should go low or high. Probably higher, I guess, because Yellen refinanced so much of it at the short end of the curve. But I don't know. I'll take a mid range 3.
Well, so it's 3.3%. So try to find on your Bloomberg or in your Wall Street Journal any rate at that level today. It does not exist. So that's the rate today. Imagine as we roll, I haven't looked at these numbers recently, but a month ago we had $7 trillion in debt to roll over the next 12 months. If that rolls with T-bills, which are at basically 4%, let's say, that borrowing cost is going to go up geometrically. The interest expense is going to soar. So this is the problem. And it's not just a problem for the public sector, but it's the same problem that the corporate sector has, because they have been borrowing short
Right.
on the expectation that the Fed was going to cut. And so far their lenders have been very accommodating, but we'll see how long that lasts.
Yeah, and help me understand this. So the Treasury, can essentially borrow at the Fed's policy rate on a really short T-bill, right? I mean, it's
Right.
very close, right?
Right.
How much of a premium do corporations have to pay? They don't get to borrow at wholesale, right?
No, I mean, aren't there only 2 AAA companies anymore? I'm trying to remember. You have to check this on the day-to-day because it changes all the time, but I think
Okay.
there are 2.
Right. My overall point just being that corporate America is more vulnerable to this than the government is, right? Because
Absolutely, absolutely. They're not going to be able to borrow at 4,
Right.
or so far, I mean, again, we have seen issues, but they've basically been swept under the rug with all the extend and pretend. So if you look at these liability management exercises, which is a euphemism for basically restructuring the debt that's coming due, it's just gone parabolic, because the lenders know that if they don't figure out a way to provide a lifeline to these companies, they're going to lose everything. So they'd rather throw a little good money after bad in the hope that once the Fed cuts, everything will be fine, and yada, yada. So
let me ask you this then. So what we're talking about here is just math, right? You're just doing the math and saying, all right, look, this is the debt that has to re-rate. These are the prevailing rates. This is how much it's going to increase.
Yeah.
The Fed's got 1,000 PhDs or whatever, right? I mean, Bessent's a smart guy. So the people in power have presumably been able to see this wave coming. And I mean, that's why they've been scrambling to try to get borrowing costs down unsuccessfully today.
Right.
What else do you think they're doing here? I mean, I don't see we're batting down the hatches. We got this massive tsunami of refinancings coming that's going to swamp things. So how are they hoping they're going to absorb this tremendous increase?
Well, I mean, I think that the hope is that we'll just continue to roll T-bills until such a time as the 10-year yield comes down to a level that's close to 3.3, which they're paying now, prevent this massive spike in interest expense. And I think that's kind of a dangerous bet to make. The alternative then is to just continue the Yellen program of just financing the deficit with T-bills.
But to your point, that still is going to increase the debt service costs on average, right? So that doesn't help. It only helps if we knock, 750 basis points off of the current policy rate at the Fed, right? So it's interesting because it makes Powell's stubbornness maybe a little more puzzling here, which is he's basically saying, I really want to make sure inflation's completely dead, but I'm risking kind of the whole credit complex and the balance.
Absolutely. But then again, it's not clear that if he does cut, that will provide relief. So it's, we're kind of in this box, because if he does cut, we still have 37 trillion in debt, and the rest of the world knows it, and they're running in the other direction, which is why I think Treasury Secretary Bessent and the administration have been pushing these other things, like adjusting the supplemental leverage ratio for banks so that they have more capacity to buy treasuries. And then most importantly, as relates to this T-bill discussion, setting up that stablecoin reserve, which will function as essentially a giant money market fund. Although right now, I mean, I think the total market cap of stablecoins is around $200 billion is my sense. I mean, it's small relative to our 7 trillion in borrowing needs over the next 12 months, but it's something. And I think that gets back to your point that you made and got so much blowback for on the tariffs, is that, we may accumulate 300 billion at the current run rate on the tariffs a year. And yes, I mean, it's not enough, but it's sure better than zero. 300 billion helps a lot more than zero.
Right.
So it's at least chipping away at it. So that, if you have 300 billion in tariff revenue and 200 billion coming in from stablecoin reserve, and that's going to grow, they're probably figuring between a
It's the
combination
patchwork.
of things.
Yeah. Yeah. It's interesting, and it does put all of those efforts into greater context when you look at it that way. All right.
Which,
Well,
in
look.
my mind, should
Yeah,
be terrifying to the average investor, that these are the gimmicks we've been reduced to finance our debt and deficits. I mean, this is uncharted territory when you're trying to get 200 billion there, 300 billion there, and you're having to find innovative ways to dig up this number. Back, just a few years ago, foreign creditors were financing all of our deficits and then some for a few years.
yeah, and so this again is why it's such a head scratcher that valuations are at the nosebleed levels they are. Right? I'm not talking about all-time prices. I'm talking about multiples.
Yeah.
Right? That for whatever reason, given all these risks, given we're in uncharted territory, doing lots of desperate maneuvers here, we're acting as if the markets have never been more full
Stable.
of opportunity.
Yeah, absolutely. But I will say, you could also make the argument that we're hitting all-time record valuations because of the untenable fiscal situation that's going to require a massive monetary bailout, and that's going to inflate everything. So yes, it will inflate hard assets far more rapidly than paper assets. But as my friend Dave Ivan, who you've interviewed, always reminds me, Stephanie, no one lost money in the German stock market during the Weimar Republic. Everything is going to hit hyperinflation levels. Right. It's just that in real terms, if you're not paying attention, you're actually going to be losing money. And in fact, we're seeing that already.
Right. Yes, they remained rich in paper Deutschmarks and poor in purchasing power.
Yes, yeah. Exactly. Well said.
Yeah. All right. Well, look, we will continue, monitoring this every 2 weeks as Steph comes on here. But I would say I would not fade Stephanie's gut prediction that the actual cutting, the Fed's decision to cut, it may actually turn out to be buy the rumor, sell the news event, right?
Yep.
Yeah.
And that's not a radical forecast. That's just forecasting what has always happened.
It's just looking at what's happened before many, many times. Yeah, exactly.
Yeah, absolutely.
I would tie to that. There's a chart which I don't have handy, or else I'd put it up, but I've shown it before, which maps the interest rates to the unemployment rate. And you always generally see, as you said, Steph, right as the Fed starts cutting is generally when we enter a recession, right? And the Fed is then panic cutting all the way down. And that tends to be when the unemployment rate has bottomed and then starts just skyrocketing, right?
Yeah.
And we definitely have bottomed in the unemployment rate. And then there's a lot of debate right now as to whether we're going to see the same pattern that we've pretty much always seen in history, or whether it's going to be different this time. And of course, nobody ever knows for certain. But if the pattern plays out the way that it normally does, not only should we see your sell the news event, but we should see unemployment really start to pick up, which we're already seeing in certain cohorts, like I think new college graduates, their unemployment rate is already kind of getting near recessionary levels.
Well, I would point out on that there's very good reason to be suspicious about the reported unemployment rate. I know my friend E.J. Antoni is going to go get that squared away at the BLS. Mm-hmm. But I would highlight that if you look at a chart of consumer delinquencies and the unemployment rate, the two lines are usually indistinguishable. And we've now had an environment where consumer delinquencies are back to where they were, in some cases since the GFC, not even COVID, but, like auto loans and credit cards, all the way back to the financial crisis. And the unemployment rate obviously is still pretty much flat on the mat. So there's something that is different. And it might have to do less with the actual employment environment so much as the quality of the data that is being produced from the BLS. So I hate to jump on that bandwagon, but I will say I have been a skeptic about the quality of the payroll data for decades. So I'm not just joining in on the administration's chorus here. I'm not banging their drum. This is something that I've been tracking because I have the unpleasant task every month of digging through all this data and, can just see that it doesn't add up. And then when you look at things like corporate tax receipts going negative year on year and the idea that employment is tight, it's like, this just doesn't add up. The number one input into hiring decisions is profits. And if your profits are contracting, you're not running out hiring more people. You're trying to cut hours and headcounts and salvage as much as you can.
Right, which we've been seeing in the data, right? Like hiring rates gone down, hours worked have gone down, average hours worked have gone down. Like we've seen a lot of signs that the labor market is cooling in that way. I actually want to talk to you about the BLS data in a sec, but real quick, how concerned are you that we might see the unemployment rate turn faster and more sharply than we have in previous downturns because there has been such prevalent labor hoarding going on? Everybody had to fire everybody real quickly during COVID and then realized, oh my God, we need them back. And it was hard and painful. You've had these, hyperscalers that have been able to absorb a lot of talent in the candidate pool, not necessarily even to put it to productive use, but just to keep it from going to work for a competitor. Right. And so there's been a real reluctance to actually fire people. So we'll put in a hiring freeze, we'll cut contractors, but we're not going to let go of our full-time employees yet. But when and if we get to that point where they say, you know what, either our profits are getting pinched enough that we got to start letting people go, and or, hey, these AI tools are now beginning to really show some results and we don't need, like, how concerned are you that we might go from firing nobody to firing a lot more people than expected?
Well, I think we've already seen a big increase in layoff announcements. If you look at the Challenger Gray data, they show you've got a pretty significant increase in layoff announcements over the last year. And we obviously have seen a lot in tech in particular, and restaurants. You've seen massive restaurant bankruptcies, retail bankruptcies.
Closures,
But I would think the more likely catalyst for a sharply higher unemployment rate would be people running back into the labor force. You had a lot of people who basically went to the sidelines because they could afford to just, spend their COVID stimulus money, and they were getting all kinds of, some people were enjoying, fraudulent welfare pay, social security, welfare, Medicaid and all that stuff that they're now cracking down on, which may force a lot of people to get back into the workforce. That, you have to kind of couch that against the immigration side of it, which is going to cut the other way. But I think that could be another factor, because you did see a lot of people, and especially working age young men who dropped out of the labor force, who could very well come back, and that would inflate the unemployment numbers. But I think while they try to get a new whatever you would call it, a new structure in place for how they're going to do the monthly employment report, who knows what's going to happen. I mean, I saw an article the other day that EJ was talking about maybe only doing a quarterly release, and they were going to look at, how the data is compiled. And so there may be a lot of dramatic changes in the picture that make people have to focus elsewhere, which would probably be a healthy thing. Like if people focused more on the weekly unemployment claims data and things like the hiring outlook expressed by small businesses in the monthly NFIB survey, rather than hanging myopically on this one payroll report in the first Friday of every month, only to find out the next month that it was completely the opposite of what they were told on the initial number.
Right. Okay. So again, I want to dig into that just a little bit in a sec, but you raise a really interesting thought, right? Which is, historically, it is the economy that drives the market, right? Meaning, companies start getting pinched, the profit margins start getting pinched, so they lay people off, people spend less, we go into recession, stocks correct, right? This time around, the market could play a big factor in the economy. And one example would be, let's say we have this blow off top that you're talking about, right? And then there's a pretty material correction, right? So you talked about how, referring to what I've been calling for years, the coming great unretirement party.
Right.
Right. And, COVID allowed a lot of people to retire early, right? Because all that stimulus goosed asset prices and, amongst all the other checks and moratoria, they were like, look, I've crossed the finish line. I can retire early, right? Well, all of a sudden, if your cost of living's been marching up faster than you expected, but all of a sudden your portfolio gets whacked by 25% or more, there's a cohort there that's going to say, I don't like it, but I got to go back to work here. And then, all of a sudden we could really be flooding labor supply at a time where the corporations, to our previous discussion, might actually be cutting at that point, right?
Yep. So, and that's very typical. That's how it normally works, is you see a huge influx into the labor force precisely as the economy is slowing down, and it creates that oversupply relative to demand.
Yeah. So, I mean, again, who knows, but we see a lot of these potentialities here that again kind of echo with history. So if you've got a more sanguine outlook, that's fine. Just don't, like I said, don't summarily dismiss the risks that we're talking about here. To your point, Steph, on the data, it's interesting. The Trump administration's had a lot of criticism for Powell specifically, but it also has raised questions about the Fed and how the Fed operates. I mean, Bessent has been actually saying, hey, maybe the Fed actually, needs to be reevaluated, right? And I think, you and I have talked a lot of times about, has it had too much mission creep and, all that type of stuff. Is there an opportunity here to kind of look at the way in which the financial system is governed here, both in terms of institutions like the Fed and data collection like BLS? So, for example, I'm sure better than almost anybody, you could pick apart a lot of the shortcomings of the surveys that are used to do the payroll data, right? The household survey and the establishment survey. We've got real-time data now. I mean, it's 2025, right? I mean, we can look at tax receipts. We can look at, actual, paycheck data. Down to the individual, right? It's the tokenized era. I mean, this stuff could all be, put on a blockchain and individually, down to the fractional decimal of every penny. Why don't we? I mean, why are we still so reliant on these heavily massaged metrics versus, like it's even take inflation. We've got the crazy hedonically metastasized calculation for CPI, but then we have a company like Trueflation that just says, look, we're just tracking millions of products and services, right? And just say, look, let's just take those real-time inputs. I mean, honestly, and I just asked this the other day, like, could we potentially turn the Fed into a primary AI decision process where you have these real-time data sources go in, a smart AI says, okay, well, if these are the frameworks that you've, the algorithm that you've given me, and, in this situation, we're supposed to cut, this situation, we're supposed to ease. And so, the AI spits out well, hey, given all the real-time data, we think we should do X. And then you have a human FOMC that still reviews the data and just makes sure. But I mean, does that make more sense? And could we potentially be opening the door to do things better like that?
Wouldn't you think? I mean, I have to imagine that you would probably have a side-by-side type of situation where you have an AI built model like you're talking about that tracks the various inputs and gathers all the data that the Fed would normally consume and presents its trajectory of where policy rates should be. And then they sit around the table, the FOMC, and they analyze that, and then they debate, well, maybe that input really shouldn't be weighted as high or whatever, or maybe AI isn't aware that we've got this policy change coming or whatever it is that's unique that they want to apply to it, but to at least start with a firm quantitative basis rather than it seems like they just kind of spitballing, but they're also spitballing on the basis of data that is clearly really unreliable. And I think to your broader question of, why do the financial markets continue to obsess about this rather than looking at trueflation and these other measures? And I think it's just become habit. Like, could you imagine if on Friday or whatever the first Friday of September is, payroll employment came out and no one cared about it? Like, it's just hard to imagine. Everyone trades these numbers. And so we're kind of forced to pay respect to data that otherwise deserves zero respect. So it's going to take a while, I think, to untrain people who have been looking at that for so long. But I think the clear problems with the data that are evident in the dramatic revisions we've seen are starting to raise some skepticism around, well, okay, if we can't trust that, why are we expecting the government can calculate CPI any better? And we know they can't. We know that the CPI is artificially suppressed on purpose because COLA and everything else are linked to inflation. So they want to keep it as low as possible, not to mention tips, so there's a incentive for the government to lowball the inflation numbers. But I digress. So I think it's going to take a little while to untrain investors from that. But I think you're totally right that we're headed to a future where most of this will be model driven. I think there is even an outfit out there that produces an AI estimate for payrolls every month. I haven't looked at that recently, but I know at the beginning of the year, people were referencing this kind of AI forecast for payrolls, and it seemed to be more accurate, not surprisingly, than the BLS data.
Wow. If you happen to remember that, send it my way.
Yeah, I will
take a look at it.
Definitely look for that.
But I think wouldn't this also, so every time the FOMC meets and gives their guidance, I have Axel Merck on the channel, and he and I do a real-time reaction to what the Fed and Powell say. And Axel has always been consistent in his criticism of the Fed, saying that it really didn't have a framework. Instead, it kind of has this sort of like, almost like the description of pornography. Like, we'll know we're at the neutral rate when we see it, right? It's very wishy-washy, right?
Yeah.
Very reactive, where Axel is much more like, no, you should have a rule set. And if XYZ happens, then you should do, whatever. And, and that shouldn't be a surprise to everybody because you have this rule set, right? So if we have this more model-driven solution that we're talking about, it also should give the market a lot more transparency. In other words, we shouldn't be like hanging on every whisper of the Fed. It would be like, look, we're all looking at the same data. We all have a pretty good sense of what's in the Fed model. So we know what the output is highly likely to be. And therefore, shocks and surprises and again, hanging on every word of the Fed should become a lot less, or at least a lot less necessary, right?
So what you're mounting is an argument that the Fed will not be the tail wagging the dog of the financial markets, that we won't get whipsawed all around, because the history of the Federal Reserve and the reason why I, and I think you, are so sort of anti their performance is that they always overstay accommodation, inflate some kind of crazy bubble that only they can't see. And then when it bursts, then they start raising rates because growth gets overheated when that bubble finally feeds back to the economy in ways that fit their two mandates, the inflation and unemployment. And they start tightening way too late in the cycle, burst the bubble, and then lather, rinse, repeat. They come rushing back in frantically, like, oh my God, the world's going to end, so let's pump more money in. And they repeat the same thing. So if you're right about this, where we're going to have more model driven, then presumably the Fed won't have the latitude to overstay accommodation or to tighten too late. Their timing will be better. The magnitude of the rate swings will be smaller. And that all should be tremendously bullish for the financial markets, because volatility generally is, equal to uncertainty, is the enemy of the markets.
Right.
But I will say this. I think there's another facet of this, and that is if we continue on this road toward, I'll call it deglobalization, or, onshoring production and doing that, we're going to create volatility in the economy. We basically will be going back to the era of the Industrial Revolution and post that, where inventory swings were what drove the economy and financial markets. You'd see growth accelerating, companies would get excited, they'd over order, demand would slow, they'd be stuck with all these inventories, the whole thing would collapse, prices would come down, and then it would hit a level where, okay, we flush that all out and we go back again. So if you look at a long-term chart of GDP growth, we had decades where it was going like this, and then Greenspan came in and basically started this, and we had the globalization movement. They both kind of coincided, where we had the Reagan, tear down this wall and the opening of global markets. At the same time, the Federal Reserve was pumping in a lot of liquidity. And so the swings in GDP became very, very small. And I think if we're really having a secular shift back toward bringing production home and deglobalization in general, we're reshoring not just production, we're reshoring the inventory cycle. And I think that's something that people don't really think about, because they haven't had to think about it. So much of what's happening now is a rewriting of the playbook from what we've all known for the last 40 years. Suddenly we're going back to a time that none of us have any experience investing in. So it's very hard to try to figure out, to change your mental framework and even fathom an environment where suddenly we're being whipsawed by inventory swings in the economy, and prices on some things are going up a lot and others are going down a lot, as we reshore this production. And that obviously could have an impact on the interest rate function as well, because the inventory swings will be dramatic, and then the Federal Reserve will have to, or will probably respond to that, and hopefully we'll have models that make it so that they don't get caught wrong-footed all the time, which right now would seem to be the most likely.
To be the order of the day, yeah.
Yes.
All right, that's actually a really fascinating point. So I've heard many arguments of how we're entering a period that is likely to be quite different than what we've lived through to date, meaning we just don't have good operating maps for it, those of us that are in active positions in the economy right now. And this inventory cycle one is another important factor that I haven't heard that much yet, but I totally get what you're saying. Let me ask you this, Steph. See if we've got enough time to chop this wood. So I know that you're concerned that the markets are going to go through some repricing event because they're getting richly valued now, as we talked about earlier. You're concerned that the economy is slowing. You're concerned about where credit's going. We talked about the debt refinancings that are going to continue to weigh on the economy. We've referenced what we've talked about in past sessions about how the consumer data shows the consumer is continuing to weaken, right? So I know you're worried about economic growth in the relatively near term here and where that could go. On the other side of that, there's all the policies that the new administration is pursuing to try to really boost economic growth, right? There's the deregulation, there's the tariffs, not just to bring in tariff revenue, but to get better trade deals for us, to get foreign producers to produce domestically here in the US, employing US workers if they want to sell their goods here, all that stuff. The Trump administration has announced trillions and trillions of commitments from both domestic companies and foreign companies to bring stuff here, right? There's the deregulation. I mean, there's just a lot of stuff going on that is likely to goose economic growth at some point. So if you can, try to sequence this for me. Right now, the administration, I think, would tell us this stuff's coming at you faster than a freight train. Everything's going to start getting better tomorrow. Yeah. There's some other people that would say, look, I think the recessionary effects are going to hit first, and it's only going to be in a year or two that we're going to start seeing benefits from the stuff that's going on now. I guess the question is can the policy cavalry arrive in time to avoid the economic slowing that you see just in the fundamental data?
Yeah, I mean, I guess the very simplistic way that I would think about it is my main concern is a highly levered economy being able to accelerate its growth at a time when interest rates are going to remain stubbornly high, and that the debt service is going to be rolling, at higher levels, and
Hmm.
that's going to be a drag on the ability to spend, basically. So you're looking at that on the one side, and then you're trying to look at income growth created as a result of all of these pro growth policies, the from not just the corporations themselves who will be generating more income because they have deregulation and accelerated depreciation and blah blah
Hmm.
blah, but also the consumers who in theory are employed by those corporations who are suddenly enjoying stronger profits. So it's a question of that. In my view, I like to oversimplify everything, is the tug of war between how much of a drag are higher rates going to be relative to how much of a boost is the increased income going to be. Is the increased income going to be sufficient to offset the stubbornly high debt service issues? And I don't think you can just answer that in one sweeping generalization about the economy. I mean, I think it's really I hate to say it, but it's going to depend. Certain sectors, certain industries will, that maybe not as levered, but also benefit from the pro-growth policies will do well. And conversely, the ones who are massively levered but don't have as much benefit upside from some of these policies will really underperform. So I think for people who are stock pickers, this is probably going to be a really interesting time to. I think what I'm basically saying is we're the era of passive investing, where you just threw your money into some, S&P ETF, and you could, close your eyes and you'd be up 15% a year. I think that's going to be over, and you're actually going to have to get back to the business of analyzing specific companies and industries and understanding the push-pull between the interest rates and the pro-growth policies, and picking out specific winners and losers. So maybe we'll actually get to a place where it's all about active investing and absolute performance rather than this passive game, which frankly I would welcome. And I think there are a lot of people in this business who would welcome it as well. But that would be my sort of very glib answer to your question, which we could probably spend weeks
Yeah.
trying to really delve into.
Yeah, it's not glib, and to be honest, it echoes a lot of what the experts on this channel say. And honestly, the financial advisors who I have on this channel every week would agree with you 1,000%. Which is they're saying, hey, look, this is why active management is so important going forward.
Yeah.
So you didn't say it this way, but I just want to restate what I think I heard you say there, Stephanie, which is we may be entering an era here where the economy continues to grow on average, but for half the economy, half the country, you might be in a recession.
Right.
Right. In other words, where like it might not be a typical recession or what we associate with, where the entire economy slumps, but half of it does well and half of it does poorly. And it depends what side of the line you're on.
And again, you're seeing this already. I mean, for the last 2 years, we've seen a parade of corporate bankruptcies. At the same time, the Mag 7 are soaring. So there's clearly some companies and industries that just cannot survive at higher interest rates. And there are others who are making so much money that the higher borrowing costs really aren't a factor for them. And
also, many of them don't have a ton of debt either.
Right, exactly. So it really depends. And then you've got the same situation in the consumer space where you have, again, and we've talked about it endlessly, that the group of higher end constituents who are just bulletproof. And then the people who are really struggling. And I would say, and have said many times on our biweekly conversations, that the average American has been in recession and is in recession. And it's just belied by these other, the higher end. And the same is probably true for the corporate sector as judged by the decline in corporate tax receipts. So I think that, it's just a question of how people choose to look at this. They tend to glom onto the headline numbers and hide, like I like to say, in the cozy bosom of averages, because that makes everyone feel good about the situation. But those averages increasingly reflect nobody. There's either the companies that are doing great or they're bankrupt. And the same is really true for consumers increasingly.
Okay, I'm going
Other than
to.
that, I'm just a font of positive vibes over
Yeah.
here.
Besides that, Mrs. Lincoln, how did you enjoy the play?
Right, exactly.
All right, look, we're coming up near the end of the hour. We still have a little bit of time left. There are a couple of big topics that I don't know if we've got time to get into this time around. And we've been so deep into this stuff, we haven't been able to pull in too many user questions. I might pull one or two in before we finish up. But your point there brings up a chart that I just want to bring up here that's been making its way across the internet for a while. So your point of like the average consumer being in recession, I do worry a lot, which we talk about, a fair amount on this channel, you and I, about the growing wealth divide and how, that momentum does not seem to be slowing. And I can definitely see, to your point, a continuation where certain parts of the economy get fed and those who are doing real well do even better and everybody else sort of falls further behind. And it's kind of sad. I mean, it kind of begs the question, like, is America really becoming a two-tier system and more kind of like a, the old aristocratic, where you've got a few people at the top doing great and everybody else just basically working for them. And I think anyways, we can talk however much you want about that, but here's a chart that really just hits home, right? Which it's the estimated percentage of 30-year-olds who are both married and homeowners over the past 75 years. And you can see in 1950, it was above 50%. Wow. Now it's like 13%, right? And when your society has basically lost the ability to form capital and form families, that is just a tremendous red flag. So I'm trying to figure it out. There we go. So anyways, I know I just kind of dumped this big weighty topic here. We don't have to spend a ton of time on it right now, but like, how big of a concern is this for you of America's sort of social fabric here?
Well, I mean, it has been a concern. And I think that I will say something very optimistic and hopeful to the shock and delight of your audience. And that is, I think that we're now at the point where the pendulum has hit its apogee and we are going to swing back the other way. And I think that's precisely what a lot of these deglobalization policies are designed to accomplish, without getting on a political soapbox. And I don't think it's a political thing. For a long time, we basically exported the plebeian task of manufacturing basic stuff to the rest of the world, or we had immigrant workers do it here. And we enjoyed a very low cost of goods as a consequence. So now the trade-off is going to be that the price of goods is going to go up, but we'll have a stronger, more even consumer segment rather than it being bifurcated with a high end and low end. Will kind of strengthen the lower and middle class and narrow that extreme divergence. I think that's clearly the objective of a lot of these policies, things like no tax on tips and the onshoring of production. And so I'm hopeful that we've hit the extremes and that chart that you just showed is at the nadir and that we're going to start to move back higher. Yeah, it's hard to, it's very natural. And this is what happens in market psychology too. When things keep going in one direction for so long, to extrapolate that infinitely into the future. But it's usually at that moment where everyone is convinced that it's just an unstoppable train that it's about to turn. And so I'm very hopeful. I mean, we haven't seen an administration tackle this issue yet. I mean, it's been decades over that entire span that your chart covers. No one has really expressed a concern for how much the middle class has been left behind and addressed why, or at least in part, why they've been left behind. And I feel like they're at least making an attempt at it. And that gives me some optimism that maybe now they've pulled the curtain and everyone sees this as a major issue. And then you get people like this lunatic who's running for mayor in New York, who's, he's crazy and he's probably a communist, but he's touched a nerve because he's talking about exactly this. No one can afford to buy a home or apartment and live in New York. And so it's just reached a point of being completely untenable. My hope is that the reaction isn't to go the communist route. We'll see.
Right.
But that the reaction is to go more the route that the administration is trying to blaze. But time will tell. In fact, we'll probably find out before the year ends.
Yeah. And that is a silver lining here, which is if you don't fight for it, you don't get it. Right. And the fact that I think, we saw in the rise of Trump first time round and Bernie Sanders, I think that was one of the first times, Steph, that this decimation of the middle class really started to make it onto the political dialogue. And then there was a huge part of Trump's campaign, and it's a big part of the social democrat side now too, right? So the people are beginning to fight for it right now. They've got to do a much better job. But all right, well, what's really interesting about this is I just recorded, I think, one of my favorite interviews I've ever done with Greg Lukianoff, who's one of the co-founders or the co-authors of the book, The Coddling of the American Mind. And folks, if you haven't watched that video yet, I highly recommend you go do it. It came out, I think, this past weekend. And, he talks about basically the cost of comfort. And the more comfortable you get, essentially, the more you lose your ability to deal with adversity. And that's sort of what has happened in American society, since the Greatest Generation. It's just been a devolution in large part because we've just become a lot more comfortable, right? We've been able to insulate ourselves, and especially our kids, from the adversities of previous generations had to just deal with as a part of living, right? Yeah. And so we've become increasingly coddled, in his mind. And what's interesting, and this is it's a strange point to make, but it bear with me. We talked about how to kind of reverse this, and one of the things that had really kind of infected our parenting style was safetyism, is what he calls, which is basically like we put a priceless amount even on an incremental degree of more safety, right? And what you end up doing is again, kind of overprotecting your kids from developing the ability to become resilient and deal with life's challenges and stuff like that, right? Yeah. And so part of the solution is to dial up the risk or dial down the safety, not recklessly, but to have a sense of like, look, struggle is what creates progress. Yeah. And I asked him outright, I'm like, this is kind of hard because you're kind of saying, large numbers on the long tail side of things, you're going to have more absolute number of rare outcomes that are really bad, like maybe fatal. So deaths of kids might go up. Are you kind of making that argument? He said, well, it's hard to look at it just that way. But he said, if you want to look at it that way, what I'm saying is yes, we might decide more risk in childhood is better, even if we lose a couple of more kids to it, because the kids we're going to lose when they start going through adolescence and early adulthood and they're unable to deal with the harsh realities of life, and they start self-harming and killing themselves, he's like, we will save way more lives. So if you just want to measure it on a life perspective, actually dialing up the risk early in life will save a lot more lives in the long run. And so there's some connection I was trying to make to to where we're going with the economy and society on this, but I think that's sort of what we need to do.
Well, I think the connection is that we have to let the business cycle work on its own. We can't subvert the business cycle. It's a healthy thing for businesses that don't deserve to exist to go under.
Right.
And
Winter is a critical season.
Yeah, I mean, when you look at Japan, for example, famous for the zombie corporations, and that's why they had deflation for decades, because companies that weren't viable enterprises were able to sustain a existence, and they depressed profit margins across the entire industry. So you need to have a vital economy where there are people who have a good business and are hardworking and succeed, and those who can't keep up fail. And that's just the natural way things are. I mean, this is Darwinian, this is it's innate. And we need to, I think, coming back to the human side of it, just toughen up as a nation. I mean, I was blown away years and years ago when I was hearing about the college I went to, safe spaces. Are you kidding me? I mean, it's just ridiculous.
That where you used to be where you went to get really challenged, right?
Exactly. I mean, and to kind of get yourself ready for the rough and tumble world out there. And now you need protection from someone's expression of their opinion, because it just is so offensive to you that you need to get into a straitjacket in a room and crawl under the bed. It's just ridiculous. So I think you're totally right that we coddled a generation. And then, I mean, there's so many layers to this, for the supporting with financial repression, businesses that shouldn't have been supported in the first place that caused deflation. But also think about things like the COVID example, where we were told, if you just take this vaccine, you'll be great. And the more vaccines people took, the more it destroyed their immunity, and they had no ability to withstand anything. They get a sniffle and all of a sudden they're on their backs because they have no immune system anymore. Because, it's, again, we kind of duct tape and bubble wrap ourselves to protect ourselves from these natural things that we have to experience to stay strong and vibrant. Anyway, that's my life.
And even vaccines aside, we kept our kids inside for a couple of years and Purell and masks, and then they went outside and then they got, wicked sick because we had protected their immune system. Yeah. So anyways, totally get it. Well, look, thanks for going along with me on this stuff. Just to scratch people's itches here. Given your outlook on the markets right now, have you made any major shifts or changes to your portfolio allocation? Are you still pretty much in the same assets that you've told us that you've been in?
I'm in the same assets. I am, again, at the margin, trying to shift more overweight the gold miners relative to the bullion itself, but I think both are going to perform very nicely. And then I got to figure out what I'm going to do when my T-bills mature. I guess I'll just start putting more of that toward miners. And I think also in the energy space, because as I think we may have talked about when we last convened, this AI boom to me is more of an energy story than an AI story. So I think that's one aspect of it that people just aren't really giving proper due. And I think we did have this conversation, and I was talking about the chart of oil prices relative to the S&P, and they're at low extremes, pretty much the all-time record low. So there are a lot of opportunities there. If you genuinely believe that AI is the future, you probably want to have a healthy exposure to the energy required to power it.
Yeah, I totally agree. You just reminded me of a bunch of questions I wanted to dig into with you here. One of which was, if cross our fingers, there is a negotiated truce to the Ukraine-Russia war. What would that do to natural resource prices, particularly oil? I mean, you would think it would bring them down in the near term, right?
Yeah, I think the knee-jerk reaction will be, okay, now we sell the hell out of this stuff. But I just would view that as a very short-term reaction.
Well, you would see that as a big buying opportunity, given the long term. Yeah.
And if what happened in the Middle East is any indication, we may not even see a dramatic decline. We probably will get some sell-off, but it may not even be as dramatic as one might think. So we'll see. Stay tuned.
Okay. All right. Well, look, first off, folks, if you enjoy these biweekly sessions with Stephanie, please let her know that by hitting the like button and clicking on the subscribe button below, as well as that little bell icon right next to it. Steph, if you can remind folks who want to follow you in between now and your next appearance on this channel, where should they go?
Well, they can go to macromavens.com, where I posted some reports that they can look at, and they can learn how to subscribe. And then I'm going to be sending you a report for your macro pass.
Thank you.
Today, I'll get that over to you today. I don't know when you publish that, but
I will publish that this week, folks, probably Thursday or Friday.
And for those of you who already think that I'm a broken record, you can spare yourself reading that, because odds are it will be more of the same. But I'll try to come up with something novel that you haven't heard me say, that I can send your way, Adam. And the only other place to follow me would be here or on Twitter at @Pomboy. But I honestly don't remember the last time I tweeted, so I better get back on there. I've been on vacation for a week, so I have an excuse.
You've got a good excuse, yeah. And I'm spending way too much time on Twitter for the both of us, so don't worry.
All right,
that's folks.
The problem. It's addictive, so I'm trying to quit the habit.
Quit the habit, yeah. All right, well, look, folks, thanks so much for watching this. As a reminder, if you would like to get some professional help in figuring out how to navigate this era of, as Stephanie has described for us, where active investing may become an awful lot more important than it has been in the past. First off, I recommend that most people watching this video get that help from a good professional financial advisor who takes into account the macro issues that Stephanie has been talking with us about here. If you've got a good one who's doing that for you, great. Don't mess with success. But if you don't, or you'd like a second opinion from one who does, then consider scheduling a free consultation with one of the financial advisors that appear with me on this channel week in and week out. To do that, just fill out the very short form at thoughtfulmoney.com. There's the URL on the screen right there. It only takes you a couple seconds to fill out the form. These consultations are totally free. You'll get bespoke advice on what they think you should do given your personal specific situation, and there's no commitment to work with these firms. It's just a service they offer to be helpful to as many people as possible. Stephanie, as always, so wonderful to see you. The time goes by quickly between these bi-weeklies, but it always seems too long. But thank you for continuing to do this. It's such a joy.
It's my pleasure. I always enjoy these. Thank you, Adam. I noticed that a lot of people screaming for Wilhelmina, so next week I'll make sure she's prominently featured. So.
All right, let me just expand you. Is she back there somewhere? No,
she's out of sight.
All right.
It's early. She's still fast asleep.
All right, next week it'll be the Wilhelmina show, and folks, we'll pull more from the live Q&A next week too. I'm sorry we didn't get too much to it this week. All right, Steph, thanks so much. This is wonderful. Everybody else, thanks so much for watching.